Good evening, everyone, and thank you for joining us this evening. At HSBC, we take pride in being the preferred banking partner for all your Indian and international needs. This session is yet another step to simplify the global currency markets for you. With the rupee having depreciated over 11% in 22, I'm sure all of you are looking forward to have a deeper understanding of the macroeconomic landscape. And this session should help you understand the currency movement across pairs in 22. My name is Aishwarya, and I head the Southern region for Wealth and Personal Banking at HSBC. I'm happy to introduce my esteemed colleague, Mr. Manoj Goel, who is the head of corporate sales for markets and securities services business at HSBC India. In his role, he is responsible for managing the FX sales and derivative piece for corporate clients. Manoj has a financial market experience of more than 18 years, specifically across FX and structured solutions, and is an HSBC veteran. Manoj has been actively involved in the development of FX and derivative markets in India due to his association with various industry bodies such as Foreign Exchange Dealers Association of India. This evening, Manoj would first share his expertise on the global currency movement, post which we would address your queries. Please do keep your questions coming in the comment section if you're watching this on Facebook or YouTube. For clients who are joined in from the Dreamcast link, please post your questions in the questions tab below, and we would seek to address most of them at the end of the session. Without much ado, I invite Manoj to take the session forward.
Hi, a very warm welcome to all our clients who have joined in. Thank you for your time, first of all, and Ashwarya, thank you for the introduction. Currency is something which has been going around for in our minds for quite some time now, and the volatility is something which we have not seen in last many years. I think the last time I remember this kind of uncertainty on currencies was way back in 2013, and the only difference I would say is that time around it was more India which was in the eye of the storm. This time around, India is actually doing quite well relatively, while we know what has happened on dollar rupee, and we'll talk about it. But it's generally the global, issue or global movements which are determining, and maybe those are some of the aspects we will dwell into. Moving on, and before I go into specifics, issues or challenges, what are driving different currencies, I think it's important to understand what is the core issue out of here, or what is driving the markets, and to us it's very, very clear what's happening is US interest rates. And for many of us, and I'm sure some of us would have seen your dollar interest rates higher, but that was way back going. If I had to go back last time when the US interest were very high, were maybe sometime in 2007. When we had dollar interest rate at 5% plus 5.5% or so. And if you go prior to that, then let's say 2000 or prior to that in 1980s, then rates were higher. But practically for last 15 years, in between we did have little bit of dollar uptake few years back when the Fed started again on the rate hike cycle, but then they had to cut down and move it back. COVID happened, other things. But generally the world has been seeing almost $0 rates. Now that has quite profound implication for the globe, because what it means is when the US interest rates are zero, and all of us know, while different economies are picking up, etc., but when it talks of global flows, it is still dollar, which is the king, which is supreme, and which drives the global liquidity, etc. When interest rates are low in your home currency, you would look to see where you can generate interest, where you can generate more yield. And frankly, if you're getting money and easy liquidity at 0%, you may want to leverage on that, and then put that money into other markets, emerging markets, even other developed market, etc. And that has been the operating model, to say, for markets for last 12 to 15 years, with little bit minor changes here and there. Now, even last year, even I would say before Ukraine war started, we were seeing the Fed looking to raise interest rates, and there were talks about what the inflation, etc., just driving because of the easy liquidity situations and liquidity which was globally available as a response of central banks during COVID crisis. So the inflation had been inching up, and the central banks across the globe were looking to see how do we tackle. And that was one way, and that is where some bit of currency moves, I will say, started somewhere towards last quarter of last year. And while the world was starting to grapple with that, suddenly we saw the Ukraine situation playing out, which of course, as all of us are aware, led to changes in the energy prices, commodity prices, etc., and which in a way added as a double whammy to what has been in a situation where Fed was looking to raise rates. And what it did, it changed the trajectory of US interest rates. So if I go back, let's say, if you're having a similar conversation last year, and we were talking about, okay, where 2023 interest rates would be in US, I think the general consensus, and this consensus, I can talk about different banks, forecasts, etc. But for me, even going beyond that, what actually the US central bank was thinking, because when they have their meeting, they come out with all the Fed members, what they have been thinking, where they think interest rate will be next few years. Most of this estimate, or the median estimate as we put that, were below 2% interest rate. And from there, we have seen the trajectory, how the rates have moved up. Currently, they have, in fact, there is, the US central bank meeting expected later tonight, where they're expected to raise the interest rates again. And expectation is around 75 basis point out there, which means the Fed fund rates, or essentially in a way, the base rate at which generally the dollar asset prices get repriced or referenced to, are expected to move to some in a range of 3.75 to 4%. And it was almost zero, it was at a zero rate 1 year back, or slightly, earlier. Now, just to put some perspective, I'm sure some of us would have taken mortgages, in India. And if I say what were the rates for home loans in India, and if I tell you what the home rates in US right now, so the 30-year mortgage rate in US right now is approaching 7% in dollars, right? I mean, that is the scale of interest rate implication and movement which is happening, and that is causing all this movement, whatever we have been talking about in currency markets, etc. And the world is trying to understand the rates will be approaching 4%, as I said, the expectation for this rate. Are rates peaking? Is that the end of the story, and are we approaching the end, so that we can say, okay, the movement has happened and we are staying, over there. But when we look at what US, rates, or to me, look at some of the statement from the Fed members itself, what they're talking about is, the first statement on the screen, we are resolved to bring inflation down to 2%. And that is what they are looking at. And inflation, clearly, the last print which came out in US was 8.2%. Now in India, we are used to double-digit inflation. Also, it's a different matter. What central bank had done over the last 5 to 7 years is really bring down inflation within that around 4%, well below 6%. But clearly for US and even for other developed market, inflation is very, very similar. They have not seen this kind of inflation. So clearly there is a debate happening out there. Are we reaching the end of the cycle on US rate, or this will continue now? But whether, even if we are approaching the end of the cycle, in some shape and form, we are expected to remain at this interest rate of this 4% plus level. Now, does it go 5% or plus? But even we're talking of 4% plus level, if not further, then we're talking of mortgage rate at 7%. So that is the kind of challenge and issues what is happening, and that is driving the movement of funds across the global markets. And as I mentioned earlier, And this chart is a good example. We have tried to capture broadly year-to-date movement on various currencies. And in the past, as I mentioned, whenever we have looked, US rate environment, other things, etc., generally we have seen emerging markets currency, Asian currencies, rupee, react much more to that. And if we had a similar chart, we have maybe some of these currencies which are on top of the chart, maybe on bottom of the chart. But this story is very, very different. It is not emerging market issue or particular issue. It is a global movement of dollar strength. Now we track dollar movement through a combination of index, which was a PYX index, and broadly over last 1 year it has moved closer to 20% stronger. It has become last 1 week or so it has given up some bit of movement from there, but generally I think the movement have been close to 18 to 20% in dollar index. And if you look at this side, and if you look at for example rupee, it's like from a YTD perspective it has just moved 10% and 11%. Whereas if you look at some of the currencies down, emerging markets, so the developed market currency, British pound, euro or Japanese yen. Look at Japanese yen, that's down by 22%. British pound 15%, and as I said, euro 12%, and this is after 2-3% appreciation of last 1 week. If you're having this conversation a week back, you can add 2.5% appreciation in all these currencies. And this is YTD. If I add last quarter, you can add a few more percentage point to these currencies. So that's the kind of movement across we are seeing. But as I said, this is not India related issues. This is not emerging market issue. It is a global strength which is driving the currencies. But yes, when these things is global movements are happening, then within that the challenges or issues of respective countries, currencies, and what is the I would say buffer or muscle power the different currencies have come into fore. And clearly some of this I would say European currency, euro or UK has come under fire much more than Asia or for that matter India. Little bit dwelling on what is happening in currency, in rupee, and we try to capture for last 4 years or so how the currency has moved from various level. As we know, it has approached just short of 83 recently, and it's currently approaching below that levels. But the main movement is, of course, the sharper movement is from 2021 onwards, late 20s onward and earlier start of the year. And I would say the reason for, and as we discussed earlier, rupee has overperformed than related to other currencies. And a few factors what has worked in favor of rupee is clearly I would say some of the good policies or prudent policies which are followed by the central bank. When we were seeing a very high level of inflow right from 2020 and middle of 2021. During COVID time, Indian market was still performing well, and there was still enough global liquidity available, and we have built up our foreign currency reserves significantly. And in fact, at some point in time last year, we were debating, what is the limit, how long, how far would central bank like to give, what is a good level of reserves. On a hindsight, it was a great decision because we kept building up the reserve. This year, that has definitely helped us a lot. Because the trade account or India's, as the economy is booming, and of course, oil prices, we know all where it went, and the commodity prices, etc. That meant our trade deficit has worsened quite a bit. But the central bank has been, monitoring the situation very carefully, and has been, utilizing the reserves. Our reserves has come down significantly in last 1 year, but still they are a comfortable position. But now, when we look at, let's say, euro or GBP for that matter, when we compare over there, the situation has become very, very challenging. So if you look at this graph, while rupee has moved, but GBP INR has come down. And as I said, it's clear reflection that GBP has depreciated against dollar more than what dollar rupee or rupee has depreciated. And broadly around, I will say 7-8%, right? That's the movement which we are looking over here. And similarly, if I go back to euro, we see that clearly is something which is happening. But moving back to GBP again, GBP and UK post Brexit, we have still seen the economy continue to struggle. Right or wrong decision, that is not for us to comment. That's the people will what was done over there. But the investment flow in UK post-Brexit has been relatively muted what they have been in the past. And while in India terms, we talk about trade deficit or current account, but when we look at, let's say, GBP, UK or Europe, generally what we look at is something on which is a core balances, which we say current account and the short-term capital flows. Now, just to give some perspective over there, the core of these flows for Europe zone has turned first time negative in the last decade. And if we talk about UK, which used to be surplus a few years back, has turned to minus 8% of its GDP. So that's the kind of movement what we are seeing in UK. And clearly, given how the trajectory of rates are, we have seen decent amount of movement or outflow further, or the confidence of the market to have that back is relatively shaky right now. And the other part is, of course, while some of the other countries may have different problem, but Europe and UK being closer to, first of all, Ukraine, and heavily dependent on their energy supplies, at least Europe, for on Russia. The energy prices are just feeding in and creating, all these issues and challenges on the core balances which you talked about, and even on the outlook side. So we are in a situation where both these economies are struggling for growth, as an overhang of the impact on Europe of the war, and otherwise we have very, very high inflation which has not been seen in decade by the countries, which restrict the how much the growth, restrict how much movement the currencies could have, or the capacity for the central banks would have to go on a rate cycle hike. So while both the central banks are hiking rates, the relative movement or trajectory between US is significantly seen higher and to continue for longer. So in a way, those are some of the challenges which is driving this relative movement between the currencies, and a reason where we still see both these currencies struggling much more than what we have talked about. Maybe Ashwin, I thought I will just pause over here, because I can go on. This topic is something, but it will be good to hear if our audience have questions, etc. Maybe we can go through that.
Thank you so much, Manoj. That was very, very insightful, and we have received a lot of interesting questions from our viewers already. So here goes the first one. What are some of the factors that you think will support INR in 2022, and what are some major risks that people need to consider here on?
Yes, I think, okay, so when we talk of dollar rupee, see, there are two parts. And first of all, maybe it's easier to talk about the risk, because that is what, we have seen about. So there are two things. One, the question which market is grappling with, as I mentioned earlier, where are US rates heading? Are they approaching a peak? And even if they are approaching the peak, are they going to stay here, or has it started impacting the growth outlook in US? And then can we start cutting rate at some point in time? That is, so US rates are clearly going to determine the trajectory for larger movement globally on dollars. And that is something we need to watch out for. As I said, while market has been talking about the impact of rates on the US economy, and likely so. I mean, if the economy will become, the rates are moved so much, there is bound to have some impact on US economy. At the same time, when the central bank is looking to cut down on the global liquidity available, they have started, tightening the balance sheet. But so far, what we have seen is the survey or the data points which have been coming have been more bearish than the actual data. Now, just to give some perspective, when we talk about home prices, etc., like, and in India, if you look at long-term cyclically, we, if our home prices move by 25-30%, it's not a surprise in that sense. We have seen cycles. But in US, there's something known as Case-Shiller Index, which tracks the home prices. It has moved by close to above 40% plus in last 3 years. I mean, so the data, and lately we have seen some moderation over there. So what is happening in US is there's no very clear trend coming around. Is Fed reaching a peak or not, or the cycle will continue? What will be important for us to watch out is the actual data points. If they start showing impact softening, then we can say, okay, soft impact is happening over there. The second risk factor for rupee has been widening of trade deficit. In our trade deficit, which used to be around $14 billion per month, has worsened to, on an average, last few, 4-5 months, we have seen it ranging from $27 billion to $30 billion. A movement of around $15 to $16 billion per month. Now, that's a very, very large number. Now, how does it get funded? funded, and at the same time, is that changing as we go along? Now, so two components. One, are we looking to see any change out over there? We did look at the sub components of what's happening over there. And to us, one, of course, oil prices, as all of us know, are a big component of the movement on our trade deficit. But there have been a lot of other components because globally commodity prices are moving. And when our economy grows well, clearly we have more import of these commodities, etc. So it's spread across. We have been having higher spend on coal, chemicals, vegetable oils, fertilizer, electronic. I think all of us can understand that's cut at it. But even precious metal, I think our gold and silver, etc. import have also grown up. With the commodity prices softening, they have come down in last few months. Potentially that could lead to some bit of softening, which provides some support to dollar rupee. But at the same time, that will still be worse. Now, the positive side is, and right now we have seen the flows have been the capital flow has been relatively limited. Now, I will divide those into two parts. One is, let's say, the capital FDI, and second is the portfolio flows. So portfolio flow, equity side, while Indian market remains robust, and that's why we'll say we did see negative outflow throughout the year, but last couple of months they have stabilized. At least we're not seeing increased outflow. So, and second part is on the FDI. Clearly, when interest rates are becoming at 4%, some of the money which we're seeing flowing into startup sector, new age sector, while money is still coming in, but I think the investors are becoming a bit more cautious because you're getting 4% in your home country. Right? So there are delays. The quantum and the optimism is slightly slow. So the FDI have slowed down a bit. If tomorrow we see change in Fed rate outlook, right, and people start investing again and try to be early, and always you see in financial market people try to move early, then things have to play out. So I would say those are some of the positives. So from a positive perspective, we see if our trade account starts seeing the impact of softening commodity prices, which comes with the lag. So if that comes, if we start seeing money flowing on FPI equity side and more FDI, I think maybe those will be some of the positive I would look at. And from a global trajectory, from dollar perspective, will be there.
Okay. Thank you. No, I think that is interesting because I think there were a lot of questions also on the trade deficit numbers, which you beautifully covered. Also, Manoj, while we are on this, right, our Forex reserves have fallen by about, $100 billion. Could this mean further significant depreciation for the rupee, considering the limited capacity of the RBI? Did we lose you?
I lost you, Aishwarya, in between.
Yeah. Okay, sorry. So what I was asking is that considering our Forex reserves have fallen by about $100 billion, could this mean further significant depreciation for the rupee, given the limited capacity of the RBI?
I wouldn't say in that context. Okay, maybe let me go a little bit deeper into how our reserves have happening, etc. See, first of all, as I mentioned earlier, the rupee has relatively overperformed than other currencies, right? I mean, we did look at how much some of our developed market currencies has moved and where rupee has been, and it has been thanks to the strong reserve position which we prudently build up over last in 2020-21. Now, I think in general, when we look at the reserve number, while they have come down, but at least the build-up has been very, very strong. And there are various metrics which are, what is the reserve adequacy and what is a good number for the country to have from a reserve perspective, apart from 6 month, 9 month imports, your short-term debt, etc. So the broad idea is there are 2-3 things what the central bank has at its disposal. One, from those metrics, there is still some decent room available for the central bank to continue to dip into the reserves. Yes, how much you go further? Maybe if we let go another 20, 30, 40, maybe 30, 40 billion dollar of reserves, there could be some questions about looking at is it enough and do we have more capacity to let go reserve. But I think another few months or we have some reserves out there which we can dip in. The other part is central bank, when they intervene, they don't intervene only in the spot market. They also intervene something which is known as a forward market, which means without dipping into the reserve, you can build in through that route. And in fact, we have seen when rupee, we had flows earlier, they were hedging through forwards as well, building on the reserve book on the other side. So now they can reverse it and do that. And third, I think over the last year, central bank has started intervening not only in the onshore deliverable market, they do intervene in the international market and through exchanges, futures, etc. as well. So I think there is a decent bit of room available, and currency market, it is all relative. It's not absolute anyway. So when we look at what's happening with some of the other currencies market, other things, etc., or other countries, I think we still are in a very good space where we look at what's happening in this space. But central bank, the government are of course looking at the market volatility very, very closely, and they're looking at what happens over there. The other part is of course what happened to some of the our immediate neighbor currencies, because that also has a big impact. And we saw rupee stabilizing around 80, and then it moved to 83. And one of the reason was again even from Chinese yuan, which has a very interesting bearing on the Asian currencies market and relative valuation. We saw they moving away from a key level, and that currency depreciated, which again from a relative basis does allow us to move over there.
Thank you. Unlike the initial theme of rate divergence between Fed and the other central banks, we have seen a hike by almost all central banks in the last 3-4 meetings given the global inflation. So what are the risks to our growth due to this?
Yes. So see, there are two parts. You're right. I think we are seeing after a long time where all central banks are in tandem broadly raising the interest rate. Though I would say the pace and the future expectations differ. So when I was looking at and explaining little bit of divergence between what's happening in UK and Eurozone, well, they have also raised interest rate, and like UK is expected to raise further interest rates. But the difference is the confidence the market has on how much US will raise interest and other things, and that is driving the different expectation on currencies. But on a larger construct on the growth implication, see, no doubt what we are going through is going to have some impact on growth. So there are various factors on play over here. One, you have the implication, ramification of the Ukraine Russia situation panning out and spreading into the entire world. What does it, and specifically let's we talk about from India perspective, India growth perspective. Clearly the global growth outlook is expected to slow down, which will have an impact on what happens to India growth in some sense. Second part will be the inflation still remain very, very high, right? So it would have impact of consumer spending, and with the raise in interest rates, clearly it will also start impacting the investment climate and the growth outlook, etc. So global growth is clearly expected to come under pressure. It is already coming under pressure, and as we go on next year is where maybe some of these things will play out more strongly, given you raise interest rate to 4%, it takes some time for it to get transmitted in the economy and start impacting, and that's the case for the central bank. But we are also seeing some of the central banks talking about seeing, shall we pause now and shall we look at impact of what it has to happen before we embark upon on further rate hikes, etc. So that has also started to be discussed right now. Still some room to go, but that is discussing. But coming back, moving domestic perspective, and India still is coming out as a very shining story when you look at what's happening, relatively, because from a growth perspective, I think the central bank came out with their guidance still. Well, it was lowered slightly in the last monetary policy statement, but it was still in the handle of 7%. I mean, 7% growth for an economy such as ours is a very, very strong number. And as I mentioned earlier, from a other perspective, from a various macroeconomic parameters, the currency depreciation, etc., I think it's clearly looking much better than the rest of the country. So yes, it would have impact. And the other part, of course, I mentioned was that globally the liquidity availability is coming down, as every central bank is looking to tighten up the balance sheet expansion, which they had done during COVID time or earlier also. So that will also have impact of how much money is available for investment and flowing into the emerging markets such as ours. So all those things would have some impact. But right now, I would say relatively, India definitely seems to be in a much better position. And also because while we'll have impact from growth slowdown, global export slowdown, but large part of our economy still is linked to domestic consumption, which provides a good comfort from that perspective.
Okay. Okay. So that brings me to another interesting question, that what are the tools Fed might have handy to tighten liquidity and keep the dollar strong apart from the rates?
See, as as I mentioned earlier, dollar just strengthens because other currencies are weakening, right? They need not do anything. In fact, I'm sure from their perspective, a 20% appreciation in the currency is not good locally for them also, right? I mean, if your currency strengthens that much, that itself is a tightening in some shape and form. So I think what they may want to do is uh, the tool or other way will be to look at their balance sheet tightening plan. There was a particular path on which they have embarked upon, which broadly, and if I just put some number and to put some perspective, the balance sheet had moved to around US, Fed balance sheet had moved around $8.3 trillion, post COVID. It used to be somewhere around $4 trillion handle before COVID. And if I go back before global financial crisis, way back in 2007, it used to be in $1.5 trillion. So that's the kind of balance sheet expansion which Fed has done. So the plan, what they started, is around, contracting the balance sheet by around $1 trillion in 1 year, maybe by July, August next year. And that is on the path that is going on. If they want to, further tightening the liquidity situation, that is something apart from the rate hike what they have been doing. They can definitely look at. They can start expanding the pace. But my sense would be, as I mentioned earlier, the transmission does take some time to play out in the economy. And the rates, like, while we know it has reached 4%, but it has been in stages. So now it will be reaching, slightly closer to 4%. It will take some time. So they may also want to see how the impact is happening on the economy.
Okay, thank you. The next question is about, with Russia becoming the top supplier of oil, 22% to India, do you expect the USD INR pair to stabilize?
See, I would say ultimately, while Russia has become the in this matter the latest news item which we are seeing, etc., and of course we need to wait and see more detail. But one thing is the price at which it is being supplied, but also at the transportation cost which gets added when you import. Now, if I just look at the global oil prices, right? I mean, yes, of course, they are way higher than what was pre-COVID, during COVID level, but COVID was a different situation. But if I go back pre-COVID level, something like international dollar prices in $70-$75 per barrel is not something which is out of the whack or from India perspective. And now if you look at the international oil prices, they're moving around this 85 handle. Right? It's just way different. And I'm talking about general international price, not nothing to do with from a Russian prices. Yes, they have moved way back earlier. The initial phase of the war situation, 120, 130, those number. But since then they have stabilized. So I would say it's not very far away from where the oil prices were earlier. And as I mentioned earlier, we tend to focus a lot more on oil price because yes, that's a direct implication. But the impact on our trade deficit has been quite high from various other commodities and other factors as well. So quite possible our trade deficit situation becomes better, right? As I said, from the peak what it has reached in the last 4 or 5 months. But still some of the other factors will continue to make that we are at a higher level than what we were in 2019. So it would continue to stretch us. And that is where some part of it is getting compensated by growth in our service exports, let's say the IT sector and other service sector, etc. But at the same time, we also need to see how the capital flow play out from the overall balancing act.
Okay. So there's a couple of questions which are coming in from our non-resident clients. One is, of course, that we are always looking for investment opportunities in the home country, from buying real estate to investing in wealth. The question has always been the timing. So with the interest rates increasing globally, how do you see this impacting investment opportunities for them here in India?
So I think again, there are various topic of the investment opportunity, what is the right asset, etc. And maybe, I will leave that to my, other experts. And I'm sure, Aishwarya, you can bring our experts on that topic with our, clients. But specifically one topic which I like to maybe touch upon over here, from an interest rate perspective. And in the past, we have always seen, a lot of money which come into India as, straight away investment in some shape and form related to the Indian interest rate assets. Either in the form of NRA deposit or other things, etc. Now, relatively, while Indian Central Bank has also raised rates, right? We our repo rate moved to 5.9%, and of course, then the linked all the curve. I mean, has moved higher than what it was during COVID, and definitely in some shape and form, it has approached pre-COVID level or slightly higher also, depending on the curve you have. But if you look at the relative movement between US and India, clearly the move up in Indian interest rates has been much relatively lesser than what's happening in US, or the trajectory also over there. So from an Indian interest rate perspective, yes, interest rates are still looks like there might be some more room from RBI to look at that. Again, a function of how the inflation and global growth outlook. They are trying to do a balancing act clearly to see how to manage the inflation, growth, and interest rate dynamics. And we can all have a debate. What is the right level of interest rate, etc. But that is, those are some of the consideration they're having. But the relative interest rate differential is coming down between US and some of our investors who, if they have a portion to invest in dollar interest rate at 4% or even higher as the trajectory is expected to move, the idea will be at what premium the Indian interest rate with the added risk of currency depreciation gets added on. So I would say the differential has narrowed, and that's one function for us also to consider when only rupee, the traditional convention or wisdom which we used to have that every year, on an average, rupee depreciates by 3-4%, and that has been the case for last whatever period we pick on. Given the interest rate differentials are changing dynamics, at least in the near term, right? The US inflation seems to be higher than right now the Indian inflation, or closer, and the interest rate are we looking at that similar dynamics? And that is a question which is being debated.
Yeah, in fact, there's one more question on the same lines, which talks about that with the narrowing interest rate differentials between the FCNR and the fixed deposit rates now, can interest rates attain parity anytime soon within each other?
See, generally, I think the logic or the the economic theory and the financial theory would be that if somebody is looking to invest in emerging markets, there has to be some risk premium, right? Which the company, any investor would like to have. So I would just say that while the interest rate differential has narrowed, but it will be difficult for any emerging market to attract capital if the interest rate remains same. So and the central bank and other policymakers will be mindful of that fact. So I would tend to believe, I mean, in financial markets, there's nothing, we can't say anything is impossible. Everything could be done. There could be dislocation, then for a short period of time, situation may pan out. But if I had to look at from a medium-term sustainable perspective, normally we would expect some more risk premium. So yes, you can say, is that risk premium enough? And I mentioned about FPI inflow into equities, but another last segment is FPI debt, and we saw significant amount of money went out in early phase of COVID, March, April 2022, and we're not seeing money come back. And that is again the same question: is the differential of interest good enough for us to attract capital? Something which our audience are asking for. So I'm sure at some stage, and as we talk about some of the tools, let's say from a central bank perspective, reserve is one measure. But the other tool, which if your currency is under pressure and you want to look at, is clearly look at raising interest rate. So I would tend to believe from a medium term and long term average perspective, there has to be some risk premium which emerging markets have to offer, including India.
Thank you. Yeah. Manoj, also, I think what is top of news now is the introduction of the CBDC, and there are some questions around that. So, what is the outlook of CBDC which has been introduced, and will it play a role in internationalization of the rupee globally?
See, this has been a very, very interesting topic, clearly for last few years, and of course, generally, number of times the central bank digital currencies get in some shape and form talked about in terms of cryptos also. But maybe I just like to make a distinction. One, cryptos are completely different, asset class, that there's different purpose what they're solving and all. And I would refrain myself from providing any outlook on what crypto can happen or where they could lead to. I leave that to people's thought. But when it comes to central bank digital currencies, clearly many central banks around the world are clearly thinking that it is the path which they need to work on. And there have been different, pilot, like Reserve Bank has taken lead, and we had the recent news article which came out, and We were one of the bank who participated with the central bank in this initiative, and some of the other central banks are thinking around along those lines. Now, clearly there are a couple of motivations, if I say, around over there. One is clearly it is being felt that digital payments, and there are different forms of digital payment, etc., which, let's say, in India we've taken a leapfrog in that space quite significantly in the last few years. But clearly, if central bank don't step in, it kind of, they serve a purpose. If they are not there, then cryptos in a way become handy, right? So why don't provide a mechanism which is backed by sovereign currency, right? It is sovereign. It's not speculating on the currency valuation or other asset class. It's just, instead of having paper, you're having to help you to make those digital payment, etc., much more seamless. Now, once you get into that path, then there are various issues, right? What is the implication for policy from a monetary perspective? Because the pace of transmission once you get into central bank digital currency is much faster. And I'll just take a simple example, right? And India has done a great job in opening those low value accounts for large population, where when central bank has to, during COVID time, when they have to get into fiscal stimulus, they were able to more easy able to send out money in the hand of people than what would have been possible, let's say, 5-10 years back. But imagine if there was this central bank digital currency and people having digital wallets equivalent in that, how quickly the money could be put down, and also how you would reduce the leakages over there. Now, so those are some of the thought. Then the other part will be, what should be the architecture? Different central banks are working around over there. Can there be common architecture? And then the geopolitical situation comes in. How do you want to manage that? And then third part will be internationalization. Yeah, like one part is domestic payment system built on that. Second is, do you use to do this in other countries and try to settle internationally? So I think, see, there's a lot of thoughts around there. Policymakers are looking at that aspect. I mean, and a lot of work is being done over there. So my take at this stage will be, clearly a lot of work is being done. The policymakers are looking at financial institution, banks such as ours are looking at and partnering with the central bank and other policymakers to see what should be the future of this technology. It's a field to watch on, and clearly there will be much more developments happening.
Thank you. Yeah, definitely. And I think that's something that people are definitely looking forward, watching very closely. Last one question, I think we are kind of getting to closure, but can you also shed some light on the impact of the recent guidance on the ability of international trade settlements to be executed in rupee?
See, there are, yes, I think in general, and if you look at for past many years, the central bank has been trying to see how they can make access to and doing business in India easier globally, from a connecting more closely to the global systems and reducing the, making it easier. And internationalization of INR is just one step in that direction, and that has been placed in for some time. For example, if somebody is looking to have export or import and they want to invoice in INR, that has been in place for some time. Similarly, let's say if companies or people have to provide intercompany financing, that has been available in that form of INR, ECBs, etc. So a lot of things have been in place. The central bank has permitted special non-rupee resident accounts, etc. So I would say a lot of things have been in place, and clearly it helps participant to able to manage risk better, to have settlements easier. Now, this particular news item has been just one additional step in that direction, where it is trying to say that if you want to invoice, if you keep rupee, and one particular aspect is, yes, you can have host to keep rupee over there and can invest that rupee into the interest rate bearing instrument in the country, which was not the case earlier. So it does help to facilitate certain trade transactions which were not earlier. But the way when we speak to our clients, look at that, while this may help solving one or particular situations, but by and large, we have various other mechanisms to facilitate the similar things as well. So I wouldn't say that there is something very significantly differently which could be done now, which was not being able to do earlier.
Okay. So thanks, Manoj. And one last question. I think there are quite a few of them which are pouring in, so I'm trying to squeeze in as many as possible. Is there any scope for there to be a different currency to replace the USD as a reserve currency of the world?
Very, very, very interesting and pertinent question. And I'm sure everybody across the globe is thinking, whether you look from a geopolitical perspective, every country, because in some shape and form this has becoming a tool, or a weapon, which could be used, and ultimately the world invoicing currencies to remain dollar, and that does give some power. And when we have seen, normally the position of building up reserves, uh, while central bank build up reserve is you have access to those reserves when you need it. And in this current situation, we have seen certain embargoes been put on that. So I'm sure every central bank is debating that, how much dollar to hold and what other things, etc. But the reality right now is, while we have seen, and not only because of that, see, I mean, if I go back 10 years, there was very big discussion, central bank reserves, or diversification into euro, and we did see some bit of movement, and then other questions. So it's quite an evolving framework. Every central bank, every person is looking at that, but the reality is, the alternative dollars are limited, right? You could go into, let's say, Singapore dollar, Australian dollar, Swedish krona, some of their currency, but what is the liquidity we are looking at over there? Then it comes to other emerging market currencies, I mean, rupee, for example, or let's say yuan or other things. But again, the geopolitical consideration come, over there. So it's and then gold. I mean, but how much money would go into gold, and it will do to its pricing, right? So it's not an easy question. We have seen a little bit of diversification, but I'm sure over the years there could be move away from dollar. But would it be material, and what is the pace of that is something we need to watch out. And right now, there are little alternatives we could think of having a material shift in the percentage of dollar reserves.
Absolutely. Thank you. Thank you so much. I think we've kind of run over on time while the questions are continuing to come. So we will definitely hope to address them in some form soon. But thank you so much, Manoj, for taking out time today. I'm sure the viewers had some great takeaways from today's session. And thank you, all of you, for joining us today and for keeping it very, very interactive with all of your queries. And we hope that we were able to address most of them. And we do hope to bring to you more and more such insightful sessions to make investments simpler, not just in India, but across the globe. Have a great evening, all of you.
Thank you.
Thank you.